If you woke up today, checked the metals chart, and felt that sharp drop in your stomach before you even had your coffee, you're not alone. Silver and gold didn't just drift lower. They were hit. Hard enough to make headlines, hard enough to trigger hot takes, and hard enough to make even experienced investors pause for a second and wonder what just changed. So before panic spreads any further, let's slow this down and separate what actually happened from what people are saying happened. Today is Thursday, February 19th, New York time. And wherever you're watching from, think about this carefully. Are you reacting to price, or are you reacting to the story attached to that price? Because right now, the dominant narrative spreading across social feeds is almost identical everywhere. Silver down mid-single digits, gold sliding with it, the dollar catching a bounce, China operating on a reduced schedule due to the holiday window. Therefore, the move must be artificial, the market must be rigged, something big must be about to explode higher or collapse lower. It sounds clean, it feels satisfying, it gives your brain a villain and a direction. But markets rarely move in straight lines for single reasons. The props in the story can be real while the conclusion is completely off, so let's look at the props first. Yes, silver took a real hit, not a mild pullback. At one point, spot was down in the mid-single digits. Futures looked even worse at the lows. It felt abrupt, like somebody pulled a chair out from under momentum traders who thought the run would continue uninterrupted. Gold was also down, though not as violently, still enough to shift the tone quickly. You could feel it in real time, the kind of tone shift where comment sections go quiet and group chats stop celebrating. And here's the first important distinction. A large move can be genuine, the discomfort can be real, and the explanation people attach to it can still miss the mark entirely. One of the first drivers being cited is the dollar. The dollar index bounced. The logic is simple and widely repeated. Dollar up, metals down. That relationship absolutely shows up often, especially during macro headline days. And today's headline environment included renewed chatter around indirect discussions between the United States and Iran, with Oman acting as an intermediary. When markets hear words like progress or diplomacy, risk perception shifts. When risk perception shifts, the dollar can firm up. That's plausible. But even when the dollar matters, it rarely explains the entire movie. It explains a scene, because you can absolutely have a modest dollar bounce and still see metals drop more aggressively than the currency move alone would justify. That's where mechanics come in: liquidity, positioning, leverage, the structure of modern markets when too many participants are leaning the same direction. Before going deeper, we need to separate something that almost never gets separated during volatile days. When people say silver is down, they're often mixing together three different arenas without realizing it. The spot quote you see on a financial app, the futures market, where most short-term price discovery actually occurs, and the physical retail market, where premiums and availability can behave differently from the chart. These arenas interact, but they are not identical. Futures can gap and whip, because traders are using leverage and stop orders. Spot can adjust because it aggregates pricing from multiple venues. Physical dealers can widen or compress premiums based on inventory, shipping timelines, and demand. So staring at a red candle does not automatically mean end demand disappeared overnight. It can mean leveraged futures traders were forced to exit positions into thin liquidity. That brings us back to the dollar move. It wasn't just one headline. Markets constantly reprice two core questions. How tight does policy remain, and for how long? Short-term rates are still sitting in the mid-3% range. The bond market continues reacting to every piece of inflation data and growth resilience. When rates feel sticky, the dollar often feels supported. And when the dollar feels supported, metals can feel heavy, especially if traders were already positioned aggressively for upside continuation. Now here's where silver behaves differently than gold. Gold is treated primarily as a monetary anchor. Silver carries a monetary component, but it also has a larger industrial personality. So when markets de-risk, silver can trade more like an industrial metal and less like a pure haven. That doesn't invalidate the long-term thesis. It just explains why silver can drop harder than gold during certain sessions. Silver tends to exaggerate. When it trends sharply. When it corrects, it can look dramatic. Now let's address the paper market argument directly, because this is where emotions spike. Yes, futures are paper contracts. Yes, short-term price moves can be influenced by heavy futures activity. But the presence of paper contracts does not automatically imply manipulation. It reflects how modern commodity markets function. Producers hedge there. Refiners hedge there. Industrial users hedge there. Funds speculate there. It is the battleground for short-term positioning. The real question isn't whether paper exists. The real question is what current paper behavior reveals about positioning. And today's behavior suggests one thing clearly. Too many participants were positioned for continuation without interruption. When positioning becomes crowded, even a modest catalyst can trigger a cascade. Here's the next important point. If this move is largely a positioning flush, then the key variable to monitor is not the next headline. It's whether selling pressure exhausts itself. When forced sellers finish exiting, markets can reverse quickly, often faster than sentiment adjusts. Emotion lags price. Think of it like a crowded theater. Everything is calm until someone shouts fire. Even if the threat isn't verified, people rush toward exits simultaneously. The exit becomes the problem. That's leverage in a market. When volatility spikes in an already volatile commodity like silver, the rush can feel chaotic. Add to that the reduced Chinese participation during the Spring Festival window. Several major exchanges adjust schedules during this period. Participation shifts. When a significant pool of hedgers and arbitrage desks is partially sidelined, liquidity can thin out. Thin liquidity doesn't automatically equal manipulation. It means the same order size moves price further. Imagine pushing a heavy object with 8 people versus 2. With fewer participants, movements become jerky. That's what thinner conditions can look like. Spreads widen. Stops cluster in predictable areas. Once triggered, price accelerates. And yes, we recently saw sharp drops within tight windows, followed by quick snaps higher. People label those flash crashes. The label is less important than the structure. Fragile liquidity combined with clustered positioning creates exaggerated reactions. Now here's where sentiment matters. Just weeks ago, optimism was dominant. Price targets were escalating rapidly. Every dip was bought instantly. Confidence was high. Markets tend to punish certainty. Fast forward to today, and tone flipped to fear. Questions shifted from how high to how broken. Fear itself is not proof of structural failure. It's a response. Sometimes fear fuels the next leg higher. Sometimes it warns of deeper retracement. The key is structure. Zooming out, silver remains elevated relative to where it spent much of the prior year. The rally into the low 100s was steep, nearly vertical. After vertical moves, markets rarely glide sideways gently. They snap, they overshoot, they correct emotionally before stabilizing logically. Long-term trend followers often watch a major daily moving average as a structural guide, not because it's magical, but because it enforces discipline. Even after today's drop, silver is not behaving like a market that has entirely lost structure. It's behaving like a market cooling off after overheating. Momentum gauges confirm that cooling. During the surge, momentum stretched. Now those same indicators are resetting, in some cases drifting toward oversold territory. That doesn't guarantee an immediate rebound, but it suggests excess is being removed. Corrections can be constructive. They eliminate weak hands. They reduce leverage. They rebuild a base. The debate now centers around pattern interpretation. Some see bearish continuation. Others see consolidation within a broader uptrend. Labels are secondary to context. After an aggressive vertical move, messy consolidation is common. Could price probe lower zones? Absolutely. Volatile markets overshoot both directions. A move toward long-term support levels would not automatically invalidate the broader thesis. What would be concerning is sustained structural breakdown over months, not days. And that distinction matters more than any single red session. Now let's widen the lens, because focusing only on the daily chart is how people lose perspective. Ratios help anchor emotion. When silver surged into the low 100s recently, the gold to silver relationship stretched into zones that historically do not persist forever. When that ratio compresses again, silver can appear to be collapsing when part of the move is simply mean reversion. That snapback can feel violent, especially for anyone who entered late in the vertical phase. But ratio normalization is not the same thing as structural failure. Another way to think about it is relative to the overall money supply sloshing through the financial system. When silver's price outruns the pace of liquidity digestion, markets often correct. Not because the story died, but because price moved ahead of absorption. Markets breathe, they expand, they contract. They oscillate between excess optimism and excess pessimism. Today looks far more like contraction after excess than permanent damage. Now let's connect something that many traders overlook: energy. While metals were under pressure, oil was also softer. The same diplomatic chatter that supported the dollar can reduce perceived geopolitical risk in energy markets. Less immediate supply fear can weigh on crude. But here's where it gets interesting. If that diplomatic optimism fades even slightly, energy can move sharply in the opposite direction. And energy is one of the fastest transmission mechanisms into inflation expectations. Oil demand does not instantly evaporate when price rises. Transportation continues, freight moves, power generation persists, consumption adjusts slowly. So if supply disruption risk reappears, oil can spike. That spike feeds inflation data. Inflation data influences rate expectations. Rate expectations affect the dollar, and the dollar feeds back into metals. It's not one straight line. It's a web of feedback loops. When you focus on a single thread, you miss the entire structure. Here's another piece that deserves attention. Miners. Mining equities typically exaggerate the movement of the underlying metal. On red days, they can fall harder. On green days, they can rally faster. That's operating leverage combined with equity risk. Today, miners initially sold off sharply. Then many of them clawed back off the lows. Not a full recovery, but meaningful stabilization. That behavior matters. If the complex were truly breaking apart, you would expect sustained weakness in the most sensitive segment. Instead, you saw responsive buying emerge after the initial shock. That suggests positioning adjustment rather than structural collapse. There's also a broader mining story developing that reinforces this point. A major diversified miner recently posted solid results and signaled increased emphasis on copper exposure while maintaining meaningful silver involvement. That move reflects something important. The industrial demand narrative for conductive metals remains intact. Copper and silver are deeply embedded in electrification, grid upgrades, renewable infrastructure, data center expansion, and advanced manufacturing. This isn't a one-quarter theme. Grid modernization spans years. Data centers continue expanding globally. Industrial usage of conductive metals does not evaporate because of a red candle. So when mining companies deliver earnings that reflect elevated commodity pricing relative to earlier analyst models, surprises can occur. Expectations adjust slower than spot prices. That lag creates opportunity. Now let's bring liquidity into the conversation more explicitly. During broad risk-off phases, metals can sell alongside equities and other assets. That doesn't mean the thesis changed, it means capital is being raised. When equity indices drop and volatility spikes, leveraged participants receive margin calls. They don't always sell what they want to sell. They sell what is liquid. Precious metals futures are highly liquid. That makes them a ready source of cash. So you can see gold and silver decline during stress windows not because they lost safe haven status, but because they are accessible liquidity. That distinction matters. Liquidity events are mechanical. Structural breakdowns are narrative shifts. Now consider positioning. During the recent run into the low 100s, speculative participation accelerated. Options volume increased. Momentum strategies intensified. Fast money entered aggressively. When markets transition from trending to choppy, that fast money exits quickly. The unwind can look like manipulation to observers. In reality, it can simply be crowded positioning unwinding under thin conditions. None of that eliminates long-term optimism. It reframes short-term turbulence. Optimism rooted only in price acceleration is fragile. Optimism grounded in structural demand. Drivers is more durable. Let's revisit those drivers. Silver is both monetary and industrial. Electrification initiatives require conductive materials. Solar installations use silver. Electronics depend on it. Medical applications incorporate it. Industrial processes integrate it. These uses are not hypothetical. They are embedded in ongoing infrastructure and technology expansion. Meanwhile, gold continues benefiting from official sector accumulation and reserve diversification. Even when Western investor flows fluctuate, central bank behavior has provided a steady bid in recent years. That shifts floor psychology. It doesn't eliminate volatility, but it changes longer-term context. Now layer in the macro environment. The Federal Reserve continues navigating between persistent inflation and surprisingly resilient growth. Policy remains in the mid 3% range. Every inflation print and employment report influences expectations. When central bank commentary sounds patient or cautious, the dollar can firm. When the dollar firms, metals can react negatively in the short term, but step back further. Government borrowing projections over the coming decade remain elevated. Interest costs remain substantial. That creates structural pressure on fiscal sustainability. Over time, such conditions often lean toward accommodative responses when stress appears. That environment historically supports hard assets. Here's the counterpoint, though, because balance matters. Metals do not require a collapsing dollar to rise. There have been periods where the dollar remained relatively firm while real assets appreciated. Demand drivers are multifaceted. Industrial consumption, reserve behavior, supply constraints, and capital expenditure cycles can coexist with currency stability. Now bring geopolitics back into focus. Markets are simultaneously digesting diplomatic headlines and regional tension signals. One optimistic sentence can lift risk appetite. One escalation headline can reverse it instantly. Consider the Strait of Hormuz. A significant portion of global oil shipments flows through that corridor. Even minor disruption risk can ripple through energy markets rapidly. Markets sometimes discount risk comfortably until suddenly they cannot. Priced in can become not priced in a matter of hours. Preparedness matters more than prediction. Let's outline scenarios rather than certainties. Scenario 1. Diplomatic progress continues. Risk appetite improves. The dollar stays supported, and metals cool further in the short term. Scenario 2. Talks stall. Geopolitical tension resurfaces. Energy tightens. Safe haven demand returns sharply. Scenario 3, no dramatic headline occurs, but the underlying debt and liquidity backdrop continues exerting pressure over time, supporting hard assets gradually. Notice the approach. It's about frameworks, not declarations. Near-term catalysts are also approaching. Central bank meeting minutes are due tomorrow. The initial statement provides the headline tone. The minutes reveal deeper internal debate. If the minutes lean hawkish or emphasize patience before easing, metals could remain under pressure. If they show growing openness to adjustment later, volatility could swing upward. Additionally, Shanghai and other Asian trading hubs will fully reopen after the holiday window. When participation normalizes, liquidity shifts. Price behavior can change simply because more actors are active. Then there's the approaching March delivery window in U.S. futures markets. Delivery months concentrate positioning and narrative focus. Attention itself influences volatility. When traders cluster around expiration dynamics, swings can amplify. So what changed fundamentally today? Industrial demand did not disappear. Infrastructure projects did not halt. Fiscal trajectories did not reverse. What changed was price and mood can flip faster than fundamentals. Investing requires separating impulse from analysis. Short-term traders must respect volatility and manage position size. Long-term participants must focus on structural arcs rather than daily swings. Ask yourself honestly, did today's drop alter your thesis, or did it challenge your comfort? That answer reveals whether you're reacting emotionally or strategically. Now let's recap where we stand before moving forward. Silver and gold declined sharply. The dollar bounced. Chinese participation was temporarily reduced due to holiday scheduling. Liquidity conditions were thinner than normal. Positioning appeared crowded and began unwinding. Miners showed initial weakness but demonstrated stabilization off intraday lows. Macro drivers remain complex and interconnected. That's context, and context prevents overreaction. Now let's bring everything together in a way that's practical, not emotional. Because at the end of the day, markets don't care about how we feel. They respond to positioning, liquidity, policy signals, and risk perception. And if you strip away the noise from today's move, what you're left with is not a broken thesis. You're left with volatility inside a volatile asset class. If you opened your screen this morning and felt that immediate tightening in your chest, that reaction is biological. Red triggers danger responses. But investing is not wilderness survival. It's probability management under uncertainty. So the correct response is not panic, it's evaluation. Start with the simple question, what actually changed? Did global electrification suddenly reverse course overnight? Did solar manufacturing collapse in a single session? Did central banks announce they are liquidating reserves en masse? Did fiscal projections shrink dramatically? No, none of that occurred. What changed was price behavior and short-term positioning. Price and mood fluctuate constantly. Fundamentals evolve more slowly. That doesn't mean blind optimism is appropriate. It means reaction should be proportional to structural evidence. If you're a short-term trader, you respect volatility. You respect levels. You acknowledge that silver can overshoot in both directions. If you're a longer-term participant, you focus more on trend structure than single-day candles. Now let's revisit structure clearly. After the vertical run into the low 100s, silver entered a corrective phase. That correction has been sharp at times, messy at others. But messy consolidation following aggressive rallies is normal market behavior. Markets do not politely digest gains, they purge excess. Momentum indicators that were previously stretched have cooled significantly. In several time frames, they are drifting toward oversold territory. That does not guarantee an immediate reversal, but it suggests the excess enthusiasm is being unwound. What would truly change the narrative? A sustained sequence of lower highs and lower lows over months, not days. A broader macro shift toward genuine tightening without offsetting liquidity support. Structural demand contraction. We are not observing those signals at this time. Now consider sentiment. Only weeks ago, enthusiasm was widespread. Price targets escalated rapidly. Every minor dip was interpreted as opportunity. That type of uniform confidence tends to precede correction. Today, the mood flipped to caution and fear. Emotional swings often mark transitional zones, not permanent endings. Miners provided an important tell. Initial weakness was followed by stabilization. If the entire complex were collapsing, you would expect sustained pressure in the most leveraged segment. Instead, you observed buyers stepping in selectively. Energy markets remain a wild card. Diplomatic progress headlines can temporarily suppress risk premiums, but geopolitical tension is not binary. It shifts. If tension resurfaces around critical shipping lanes, energy can move quickly. Energy feeds inflation expectations. Inflation expectations influence rate forecasts. Rate forecasts impact currency strength. Currency strength feeds back into metals. The web remains interconnected. Upcoming catalysts could amplify volatility. Central bank minutes can adjust rate path expectations. Reopening of Asian markets can normalize liquidity. The March futures delivery window can concentrate attention. None of these guarantee direction, but they increase the probability of sharper swings. Now here's something important that many overlook. Markets can move sideways for longer than participants expect. After extreme runs, digestion can take time. That sideways period can feel frustrating. It can shake out impatient holders. But consolidation is not failure, it's recalibration. The industrial case for silver remains grounded in tangible projects. Infrastructure upgrades span years. Semiconductor production continues. Electric vehicle manufacturing incorporates conductive metals. Renewable installations persist. These are not overnight phenomena. Gold's demand profile continues benefiting from reserve diversification trends. Central banks operate on strategic horizons, not intraday momentum. That steady bid changes the psychological floor, even if daily volatility remains. Meanwhile, fiscal trajectories globally remain expansive. Borrowing requirements over the next decade are substantial. Interest burdens are meaningful. When financial stress emerges, policy responses historically lean toward accommodation. That backdrop historically supports tangible assets over extended periods, but markets rarely move in straight lines from macro logic to price. There are detours, there are shakeouts, there are positioning flushes. So what should you focus on next? Not headlines alone. Watch whether selling pressure persists or exhausts. Watch whether rebounds are weak and quickly sold, or whether buyers step in decisively. Watch structure, not noise. And perhaps most importantly, watch your own behavior. Are you adjusting your thesis based on structural change or reacting to discomfort? Are you managing risk appropriately for your time horizon? Here's a grounded recap in plain terms. Silver and gold experienced sharp declines. The dollar strengthened modestly. Chinese market participation was reduced temporarily due to holiday scheduling. Liquidity conditions were thinner. Positioning appeared crowded and began unwinding. Miners initially fell but showed signs of stabilization. Macro drivers remained complex and interconnected. Industrial demand drivers remain intact. Fiscal and liquidity backdrops remain expansive over longer horizons. None of that guarantees immediate upside. It does suggest today's move fits within the range of volatility typical for this asset class. Now ask yourself one final question. If price stabilizes and begins rebuilding structure over the coming sessions, will you view today as warning or opportunity? That depends entirely on your framework. Markets are dynamic systems. They test conviction. They reward patience and punish certainty. They amplify leverage and expose emotional bias. And silver, perhaps more than most widely traded commodities, exaggerates both fear and greed. So instead of asking whether the market is rigged or collapsing, ask whether the conditions that drove the longer-term thesis have materially shifted, because if they haven't, then volatility becomes part of the process rather than proof of failure. As always, this discussion is for educational purposes based on publicly available information and observable market behavior. It is not financial advice. You must evaluate your own risk tolerance, time horizon, and strategy before making decisions. Volatile assets demand discipline, but discipline starts with clarity, and clarity begins when you separate price from panic.